Hi everyone. In this lesson we have to look what do you mean by ratio analysis. Ratio analysis is one of the important tool for financial statement analysis. By using different types of ratio, a businessman or a manager or any business organization, they can analyze and interpret the financial statement. It will help to understand the soundness and the performance of business concern. This is a concept which coined by Alexander Wall in 1919. We can say it is a techniques for analysis and the interpretation of financial statement. The ratio in simply it's a one number expressed in terms of another number. It shows the numerical relationship between two figures. That means it can be found by dividing one number by another number. We know that a single figure by itself has no meaning. A figure may become meaningful when it is compared with some other information. There are different kinds of ratios are there. Next, we can discuss the concept of accounting ratio. Accounting ratio is nothing. Those ratio calculated from the financial statement. Financial statement, we know the different types of financial statement like balance sheet, profit and loss account, cash flow statement, fund flow statement. Okay, when the ratios are calculated out of the informations or the elements of different kinds of financial statement, it is known as accounting ratio. A definition given by J. Bharti related with accounting ratio. The term accounting ratio is used to describe the significant relationship which exists between the figures shown in a balance sheet, profit and loss account, in a budgetary control system or any other part of the accounting organizations. From this definition, we can understand that accounting ratios is the ratio used to measure the significant relationship existing between the figures shown in the balance sheet and profit and loss account and other statements. For example, one of the ratio is liquidity ratio. Liquidity ratio, under the liquidity ratio, it should be further classified into two, current ratio and quick ratio. In case of current ratio, it should be used to calculate the liquidity position of the company. It calculated with the elements of balance sheet, that is current asset and current liability. The current ratio's formula is current asset divided by current liability. That measure the relationship between the current assets and current liability. For measuring the liquidity position of the company, it should be indicate the most standard proportion is 2:1. This is one of example of accounting ratio, that is current ratio. That should be based on the information of balance sheet. We can analyze the balance sheet elements of current assets and current liability by using current ratio. Then next we can look what are the expression of ratio, how the ratio should be expressed. It can be expressed in 4 terms by the way of proportion, percentage, times and fraction. By the way of proportion, we can know the relationship between two figures expressed in common denominator. It is termed as a proportion. When it is termed in percentage way, it is called percentage, and times and fractions, so on and so forth. This is the 4 ways for expressing ratios in our accounting ratio analysis. This is all about the ratio analysis introductory part. We discuss here what do you mean by ratio analysis and one definition given by J. Bharti and the ways for expressing the ratio. Thank you.